a second one, and we'll host it with a different account.
All right, we got to start the meeting if we're going to have the meeting because we're late, and I don't even know if we can have it because the public's on. So we'll have a discussion about that. But let's get the meeting started. We got to figure out the technical stuff later.
Yep, we are up and recording now.
All right, I'd like to call to order the special meeting Wednesday, April 22nd. Let's start with the Pledge of Allegiance. Pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. With that, the meeting is called to order. Before we get to public comment, I'd like to say as people now come on and we're going to have more public comment, we're going to try to limit these to 3 minutes as much as possible, the public comment, and then we'll see how it goes from that point on. I'd like to now go to Matt to discuss, or Matt, do you have a minute by chance? Are you pressed for time, crazy pressed for time or not?
I don't have a lot going on tonight, so yeah, I'm good.
Because I think I'd like to have Dan walk through the decision tree first so you could see where our mind is headed. Because then maybe you can talk to the points of what we're looking at. So it might tailor your conversation a little bit to you understand what we're trying to do. So when you present to us, it may tie in better. How's that?
It sounds fine to me.
Dan, do you mind?
Sure, no problem. So
I'm sorry, are we skipping public comment?
Oh, apologize. I'm trying to move on. Any public comment? Mr.
Rich Saluga raised his hand.
All right, Rich, you're on.
I'm okay. Rich Saluga, 32 Great Heron Lane. One question, are the meetings archived anywhere that we can look at afterwards or no?
Yes, all the meetings that we've been hosting on Zoom, I've also been putting up onto the town's YouTube page. It's actually listed in the agenda itself. We've usually been giving out the YouTube link.
Okay. Couple of comments. One, I think the three boards have two jobs. One is to consolidate the savings for this current budget and also to look at modifying the budget expenses for next year. I know that you're going to probably use some of the savings for this year to look at the budget for next year, but I hope that you're just not using the savings for this year. I think that there are budget expenses that need to be modified, and I'm hoping that all the boards look at that, as Mr. Rooney asked them last week to do. I hope they take that seriously. The Board of Ed seemed to do that. At least the Finance Committee seemed to be working on that the other night, and I trust that the Board of Finance will do the same. I also think sacrifices should be made across the board. You're going to be asking the taxpayers, unless you come up with a 0% increase, you're going to be asking the taxpayers to make a sacrifice in this economic time of upheaval for a lot of people who've lost jobs, businesses closed, et cetera. Then I think everybody in the town needs to do that, including the employees. And so I think there are some areas where you guys can look at seriously at reducing. I'm a little concerned about some of the employees who've received a big bump in salary either last July or this past January, also getting another increase this coming July. I think that's really untenable when you're looking at the current economic environment for a lot of taxpayers. So with that, I wish you luck, and I'm hoping that you guys do well. The one thing I did make a mention to Mr. Rooney is you might want to look at the Board of Selectmen. The two selectmen, according to the charter, are supposed to get no less than 5% of what the first selectman gets. So you might want to look at that because the numbers don't seem to make sense to me. Thank you.
Thank you. Any other public comment? Dan, roll on.
all right, so at the last meeting, I threw out the idea of, having a decision tree, if you will, to kind of make sure that we're moving forward and accomplishing everything we need to accomplish. And at Glenn's suggestion, I sent along my thoughts to everybody, so I'll just run through for everybody's benefit on the committees, on the phone, and in the public, kind of how I think the board can get from here to there, assembling all the information we need to, and also making progress along the way. So the order of events in terms of decisions need to be, I think, to first finalize any available fiscal 2020 surplus, netting out both overruns and savings for the year on both the education and town side. And then once we determine that, determine the best way to utilize that surplus, buying it over a single year, 2 years for a specific purpose or something else. Parallel with that, simultaneous, there is unused bonded capital on the Board of Ed side that we need to finalize that availability and also determine how to best apply that to future budgets. There's lots of options. Ricky can talk to that. And then once we look at those two things, we get a preliminary mill rate, preliminary budget, and determine whether that's sufficient or not. Assuming there's more work to be done, then we look at potential cuts on top of the surplus and look at the cost benefit of cuts that have been identified by the different boards, determine which ones we think we should apply and which ones we shouldn't, then do another pro forma on the budget and what the mill rate is, determine whether that's sufficient or whether we need to move forward. Assuming we have more work to do there, there's two ways to go. One is a top-down expense cut, meaning that you just say, all right, here's where we are and here's where we want to get to. So we just take a flat percentage across the board. That's one option. We can also look at that point, potentially taking money out of the general fund and applying it to the budget in order to reduce taxes as well. And that's what we want. The impact of that is one of the things we'll be discussing in today's meeting with our financial advisor. At that point, we would have what we would believe to be a final budget that would be ready to present to the public. Then we go to public hearing in the middle of May. Get that feedback, continue getting updates and potentially make changes, adopt a budget and set a mill rate. All along the way, we would continue to get updates on surpluses and expenditures, continue to get updates on any change in the executive order process, and do a continuous feedback loop as we were doing that. So that's kind of the in my mind, the logical order. And what I think today's meeting is primarily information gathering. In my mind, and Glenn can run the meeting how he chooses, but in my mind today is getting as much information on the table as possible, not necessarily making any decisions. So with that, that's kind of the thought process that I laid out for us this week.
Perfect. Dan, Marcia put your thing on the screen later, but Matt, I think now you got an idea of what we're looking to do, the options we're looking to do, and now it's your floor, Matt.
All right, thanks, Chairman Rooney. I appreciate the opportunity to be here. I'm willing to kind of go over whatever it is that you want to talk about specifically. I mean, obviously, these are very challenging times from a budgetary perspective and many other perspectives, quite honestly. And I'll say that this is probably the fifth conversation I've had with this exact topic in the last probably 4 hours. So everyone might be in a different seat, but they're all in the same boat pretty much. So we've really been, kind of trying to look at, what options you all have in terms of making decisions based on upcoming budgets with respect to maintaining a rating and not putting too much pressure on a rating, but also sort of being able to keep the town running and do what you have to do. So, I mean, I could give you a quick overview just really quickly of the market, because I know there's probably some questions with respect to the municipal market, bonding, that kind of thing. And then get a little bit more specific into, your questions with respect to budgeting and what options you might have and how they might reflect on your rating. Does that sound about right?
Yes, sir.
All right. So just quickly, with the COVID-19, we've had around, if you go back to February 20th to March 20th, the Dow, as everyone knows, the stock market took an incredible hit from about 29,000 to 18,000 in about a month. At that same time, 10-year Treasury went from roughly a 163, and it had never gone under 132. And in about a month's time, it went down to 50 basis points. It's about 63 basis points today, which is crazy. It's at least not negative. In the meantime, municipals had been following. So if you're not involved with the municipal bond market, you figure, okay, Treasury rates are low, municipal rates must be low, just like normal. And that was true until about March 10th. And literally when the 10-year Treasury hit the low point, the municipal market basically imploded for about a week and a half, where we experienced 9/11 and the financial crisis all at the same time, but a little bit worse, just from the perspective of the impact on the municipal bond market. And it pretty much locked the market out of any new issuances or anything like that. So we had been in a scenario where we postponed every sale we had in the few weeks following that time period. A few deals got done across the country. They were absolutely awful. I don't know why they were brought, but we've returned to a place where issuers, particularly those who have high credit ratings, like a AAA or a AA plus, have now been able to access the market. We're going into probably the second full week where we've seen new issues come to market, particularly AAAs, and have performed very, very well. The spreads as you go down the scale to AA, low AA, single A, and those kind of categories are still having a hard time because the spreads are still very wide. Because with that, when the market imploded, there was just no liquidity for the municipal market. And now that folks are starting to jump back in, they're really being more discerning with respect to credit, which is obviously why we want to maintain, the town would want to maintain the AAA rating, if at all possible. So, just to get perspective, if you were doing a 20-year bond issue today, that rate would be right around 2%, maybe slightly over, maybe slightly under. That is, in the 20 years I've been involved, there's only maybe 10 or 15 deals that I've ever seen go under that level. So it's extremely favorable right now. So at least from that perspective, to the extent that you have projects that might be coming up, obviously you do have a rather large one. It looks like the market has stabilized in the municipal side of things, and bidders are flocking back to the market. Rates are low, and things are good in that regard. At the end, towards the middle and end of March, when things kind of went a little crazy, that 2% was really something like a 4 or 450, and there might only be 2 bidders that would even be in line to bid, because nobody wanted to put their capital up not knowing what was going to happen. Everyone was going into cash or treasuries. So the municipal market has stabilized quite a bit. A lot of deals are in the market. And that's kind of where we are at this point. So as far as going forward later this year, next year, I mean, who knows, but at least, if things are to sort of remain on the same track, we should be in very good shape to, borrow what we would have to borrow at a attractive interest rate.
And Matt, can I jump in and ask you a question?
Sure, Steve.
We're anticipating borrowing $63 million for the new school. I'm not trying to put you on the spot, but is this a good time to borrow those funds? Because I don't think rates are going to ever get as low as they are right now.
It's a great question, Stephen. And there's a lot of things that drive when you bond and when you don't. One of those things that's a primary driver is when you need the money. If you look at cash flows and you're at a point where, okay, in the next 10 or 12 or 24 months, or even if you've spent money already and are looking to spend it coming up in the next year, and you can justify the need for those cash flows with bond counsel, it might make sense to do so strictly because of the interest rates. Now, that's not to say that by bonding a big chunk of that now and what the impact might be on the taxpayer, and there's all those considerations and impacts to the budgets. There are a lot of considerations that have to be accounted for. But strictly from a bonding perspective, rates are very low. Now, that being said, what drives rates in a normal environment? Inflation, those types of things. Where's the Fed funds rate? The Fed funds rate's at 0 now, as you probably know, and there's no sign of that going up anytime soon. So I think we're in a period where we're going to probably see pretty low interest rates for some time, because we're not going to have growth. There's not going to be much inflation, and the Fed funds rate's going to be on the floor. So in terms of where interest rates now, I think, yes, it is a good time to bond if you need the funds and can work it into the budget. At the same time, I don't see them going up too swiftly anytime soon. But then again, I don't have that magic ball.
We have time to consider this, and
I do think
this
so.
is almost off topic. We're having a conversation this week with the project manager who's working for us, and they're going to give us the cash flow, what we need, when we need it, but it's going to start flowing out next year pretty quickly.
So a lot of the conversations we're having is there might be communities where you're kind of like in the same position as you guys, where you're kind of at the beginning of a project. You say, well, we're going to need this amount of money for the next 12 months. Maybe we should do a note issue, and we'll bond it a year from now. It's compelling enough to have the conversation to say, well, maybe instead of doing a note where we know long-term rates are among the all-time lows now, at least maybe lock up half of that or some portion of that where you can build it into the budget fairly easily and but not put yourself out there and be exposed to rates going up a year from now.
Yeah, don't get out on the bleeding edge. Okay, thanks. We'll come back to you on that. We have to have that discussion too, guys.
Okay.
Excuse me, if I could, Mr. Is it Spondel?
Spurndle.
Spurndle, thank you. As a public meeting, I'm just not sure if you were properly introduced, your company, your role. Sure. If you could just say that before.
Yeah.
Good point.
Absolutely. Sorry. So I'm Matt Spurndle with Phoenix Advisors, and we're the town's municipal advisor with respect to all the bond issues and credit rating agency involvements and so on and so forth. So
thank you.
Helpful. Sorry about that. So do we want to get into sort of now the impact on the budget and the things that you might be considering with respect to doing and maintaining a rating and that kind of thing? Or
absolutely. That what the main goal is, we're all, I think, in agreement. Everyone here is, how do we reduce the tax mill rate without affecting the taxpayers, and to ease the bump going into next year on the catch up. So we're looking at all options of the best way to resolve our issue. We might have some, and I don't know if Steve's talked to you, we may have some surplus from this current year because of the closures. So we may have anywhere between $500,000, $800,000 on the closures, but we're looking at, if we wanted to get to a 0 increase, and I'm not saying that's a number, I'm just using it as a term, could we take money out of the general fund? What's the effect? I think, Steve, am I talking what we want to hear? Or?
Yeah, no, that's fine. You know how I feel about taking money from our general fund.
No, we don't want to do it, Steve, but we owe it to the town to look at the options and the impacts.
Sure.
So,
And I guess, Matt, what we're asking is, at what point would rating agencies or possible investors look at us and say, these guys are not looking at this the right way? I mean, this is an emergency. We did borrow money when we had the macro burst, and we borrowed money. We knew we were getting some money from FEMA, and it didn't affect us. Our rating went up. But at what level do you think, Matt, we would be before investors and rating agencies would say, hey, these guys are taking an easy way out? I don't mean that disparagingly, but I think what investors and rating agencies look for is people who stay the course, people who take the hit, work hard, understand what the problems are, understand what the residents want, but still manage to maintain their general fund. And now I'm making a political speech there in a little bit. So Matt, you don't need to talk politically, but can you give us an overview of how the rating agencies and how the market looks at towns like ourselves who
Sure.
would go into their general fund?
Absolutely. You raise a lot of good points there, and you're absolutely right. Stability is probably one of the hallmarks of any strong credit with respect to on the municipal side. Stability, positive trends, being able to work through things as they come without raiding the rainy day fund, if you will. And obviously that goes a long way. Now, that being said, things do come up and it does rain from time to time. And there do come times where issuers may need to make some difficult decisions, but it's important that, whatever the decision is, when we're in that call with the rating agency, when it comes that time, it's not as if we're going to talk to them tomorrow or next month. I mean, we might talk to them 6 months from now or a year from now. But when that time does come, they obviously know what y'all are dealing with. I mean, you're not alone. That's probably the good thing here is that, unfortunately, everyone's in this together. So they're going to see broad strokes of issuers doing things and having to make decisions that they maybe didn't have to make before. You've seen the executive orders that have come down from the governor with even paying taxes and things like that. So this is definitely an unprecedented situation. So that being said, whatever we decide to do as a town, whether it's and I'll get into it more, but whether it's some combination of a use of surplus or fund balance, or perhaps, postponing capital projects or bringing your expenditures down as much as you can, things like that. Whatever that decision is, it's going to be a matter of when we're in that rating call, we're, sitting across the table effectively from S&P or whoever it is, that we can explain to them what we did, why we did it, and what the plan is to restore anything that we may have done. Okay, so that's kind of the overarching theme there. But with respect to, okay, we have these needs, we need to either cut costs or use surpluses or not totally fund things that we might have funded in the past. You say, well, is there any low-hanging fruit? What's the low-hanging fruit? And this is coming from me strictly through the lens of your rating. So this isn't me personally or anything political. This is just really through the lens of the analyst. And as far as the low-hanging fruit goes, there's really not a lot of it. But I think if you looked at fund balance relative to funding OPEB or funding pension or these kinds of things, fund balance rises to the top as far as those items that the rating agency is going to see immediately, and that those all the comps that are done and the peer analyses that are done over the course of a rating, that's the first one that they probably are going to look at. So if we're looking at your fund balance levels, and I'm just glancing over at the rating presentation we did this past I don't know when it was, January or something, but the unassigned fund balance, roughly on a GAAP basis, a little bit over 10%, which is in good shape, pretty much in line with AAA's. If we're going to look at the range from AAA's in Connecticut is around 8% to almost 20. So your range, you're a little bit on, you're mid to lower medium just a bit. But that's not to say if it goes down to 10% or 9.5%, that it's automatically going to trigger a downgrade. What I will say is, and I forget what the policy level is, because I think you're working on, I think the policy is not necessarily in place yet, but we talk to issuers and say, listen, if you have a 12% fund balance and it goes to 10.5, and your policy says as long as you have something over 10 or 9%, that's not the worst thing in the world. What's the one thing that we look at first is whatever reduction you make, are you still going to be in line with your policy? Okay, you don't want to just break your policy if you can at all help it. And secondly, you say, well, if we're at 10.5% and we go to 9.5%, you could probably get through that from a credit perspective. Chopping it in half or taking 2/3 of it away to stick into next year's budget is going to be a problem regardless of anything else you try to do. So I say fund balance, it's very visible. Try not to, reduce it too much, obviously, but I think it's something that can be used in concert with some other things. And what other things are they? Well, one thing is, say, if you had capital projects that you maybe weren't going to fund right away and be able to push those off a little bit, that's an option. Some folks say, well, what about pension funding and OPEB funding? You make your 100% ADEC every year. I'm saying you is in a AAA town typically. The funding level is overall well funded. Is that perhaps something that you can do to, perhaps reduce that funding for a year to help ease this budget process along? And to that, I'd say, if you're looking at either pension or OPEB, typically OPEB is going to be the lower hanging fruit, just because it doesn't quite get the same level of headline as pension. So we're talking with a lot of communities that most likely will be reducing their OPEB funding at least 1 year. And the other is obviously pension, where it obviously gets more press. It is potentially something that should be at least considered if you really want to hit that zero budget increase and you don't want to completely raid fund balance. But whatever we do with respect to fund balance, pension, or OPEB, it's not necessarily the act of doing it. It's how are you going to restore it, how quickly, and what's the plan? And that's going to be, I think, what's most important when it comes time to really sit across the table from these guys and give them comfort to know, okay, you weathered the storm, you did what you have to do, but here is the plan going forward, and the plan would be to restore it.
Yeah, well, you have to pay the piper. So if we hit OPEB or
Exactly.
pension or any other funds, we're going to have to restore them next year. And it's almost a double hit.
Well, that's exactly right.
And we have to put together that plan so that rating agencies and investors will say, yeah, they know what they're doing. They're smart. They're working hard. And they have the financial backbone to do the hard things. And that's what I'm worried about when we hit like our pension plan. We've always funded ADEC 100% for the last, I think, 12 years. We're right where we want to be at almost 100% funding. OPEB, I have a little less concern with because we pay as we go and we're starting to buy it down. We've taken OPEB obligation, total obligation from 27 million, I think, down to 11 million over the last 4 years, and that will continue to drop. So I'm not quite as concerned there because I think the rating agencies would say, okay, they've got this under control. They know what they're doing. Would you agree with that, Matt?
I think that's a fair statement and accurate. Yes, absolutely.
Okay, thank you. Anybody else have questions?
Yeah, Matt, this is Dan Dvorsitz. Appreciate the overview, very, very helpful, and answered a lot of the questions I had going into it. So that's helpful. One question I have has to do with kind of rating agency trends with regard to fund balance in particular. And it seems like that AAA range has been trending upwards, and I almost feel like we're chasing it. We're always a little bit behind the chase. So whereas when I started looking at this several years ago, I thought 10% was really almost a magic number, and now it feels low.
Right.
So my question is, do you see that trend continuing, or in this environment over the next year or so, where there's so many competing priorities for budgets, will you think the agencies will relax that trend a little bit?
That's a great question, and you're exactly right. I've had that same conversation with rating agency analysts over the years and many issuers. It seems like the goalposts keep changing on you. Just when you got that kick lined up, the post moves, and now all of a sudden, you're not where you want to be. And you're right. I think for a long time, really for a long time, when we used to call it undesignated fund balance, you had 5% undesignated, 10% total fund balance. We're kind of like the rough estimates for where you want to be. Now, I don't know if it's just because there's more data available or there's more transparency, over the last couple of decades. I'm not sure exactly what drove it, but the bottom line is these rating agencies, for better or worse, look at your issuer, the issuer's fund balance relative to the peer group. And unfortunately, that number just has continued to go up, so that when they say, well, you're at 10.5% unassigned fund balance, which is a good number. It's hard to say that that would be considered weak. They'll say, well, that's nice, but the median for Connecticut is roughly 12.5. And it's like, okay, so you're a little bit below the median. Now, that can change next year and the median could be a little more, a little less. I think to your point, with respect to what to look for in the coming year or two, I think it's inevitable, just from a data perspective, not even from how the analysts view it, but I think you will definitely see that median come down to some extent. I mean, is it going to go to 6%? No, but maybe the 12.5 comes down and is 11.2% or something like that. So rating agencies really do, unfortunately, grade so hardly to the peers. On another topic, or related to that, is unfortunately the national medians, and I think we've talked about this before. The national fund balance medians are like 25 to 30%, and for AAAs. So when you're in a scenario where you have a much more volatile revenue source that you rely heavily on, like a sales tax or something along those lines, they require you to have a lot more fund balance to maintain that level of fiscal strength that they would expect from a AAA. Fortunately, Connecticut doesn't necessarily have to keep those levels because you rely so heavily on property tax, which is considered probably the most stable source of revenue that there is. So unfortunately, you're not over reliant on the state of Connecticut for aid. So there's reasons why you don't need to maintain those levels, and you have there's wealth and there's other things that go into it. But I do think that you'll see a reduction going forward. That's not to say that just because everyone's come down, that they'll just say, oh, well, the whole group came down, so we're happy, everyone's good, keep your AAA. I think it's going to be very important that as those fund balance levels do come down, that everything else is kept as strong as it possibly can be. Because if you see some reduction in fund balance, and then you're not hitting your pension fund for a couple, your pension ADEC for a couple of years, your grand list all of a sudden takes a hit, maybe your tax collections come in under, now all of a sudden you have too many concerns and weak data points that would lead to some credit pressure going down. But I like I said, they're going to be having this conversation with issuers at least for the next couple of years, because you're going to see, you only have so many options, and none of them are great from a credit perspective. Thankfully, you have built up the fund balance to a level that at least you have some flexibility there if you need it. Where there's a lot of communities that might be in the single digits that are going to be in much more difficult shape, and you will see downgrades, absolutely.
And then my only other question is mentioned, and it's a very good point, the plan to replenish if anything were to be taken. Not saying we will or won't, but what do you think the time horizon for that is? If we took 500 grand, let's say, would you advise that would have to be replaced in the next fiscal year, or can you do it over a period of years?
I think what's probably most important, it's not necessarily that it's a 1-year fix or a 2-year fix. It's just the fact that the analysts are aware that your plan is to replenish it. I don't think it's something that you have to do overnight. What's worse is you say you're going to do it and then you hit it again the next year. And that's when you have those kind of problems. And I mean, we're talking 500,000, here or there. I don't think those numbers are going to have a huge impact on your rating, on your rating. Like I said, if something were done and your percentage were now to drop significantly, into the single digits or something, then that would be very concerning. But, to use it again with some other things that you have that are, your options to potentially mitigate, what you're dealing with, I think it seems reasonable to me. Of course, in a perfect world, we continue to grow the fund balance every year and everybody's happy. but that's not the reality that we're in right now, for sure.
Thank you.
All right, so how about this scenario then? We use our surpluses, we get down from a 3.5 mil rate increase to say 2 mils increase with our surpluses. Would it be, and Steve's thing is stay the course, stay tough, work through it, or would it be better to take that 2% out of the general fund, knowing we got to borrow $63 million a year from now, or bond $63 million a year from now? Where is our bigger bang for the buck? Take the chance on the general fund and take a chance on possible paying higher points, or stay in the course at 2%?
Keep in mind that the 2% is 1.4 million.
Right.
I mean, that's a good question. I don't know how to answer that with, right off the top of my head, but I mean, yeah, there's obviously the challenge of the big issue that's coming down the pike, and 2% is basically where you've been. Is that what we're talking about with your?
No, we got a
budget?
3.5 right now as the current budget stands.
Okay.
Mill rate increase around that. We got to look at. We're looking at
3.56.
3.5. We're looking now at the surpluses from the town being shut down, the schools being shut down. So we're going to have a pocket of surplus money that we're going to strategically look on how to maybe get the mill rate down. If we get the mill rate down to 2% with these savings, is there a benefit to using the general fund to get down to 0, or are we really going to put ourselves on the edge of when we go to borrow, we could be paying more than that decrease in interest?
Well, that's a good point. I guess what you're saying is potentially you hit that general fund a little heavier, and now all of a sudden you're putting your credit at risk. Is that potentially?
Yeah,
where
that's exactly what I'm saying. The cost of
Oh
that
yeah,
is going to
I-
outweigh the 2% paying now is what I'm trying to weigh out.
yeah. I think the difference, especially considering where you are with respect to that project, a one-notch downgrade would not feel good, and would well offset any benefit that you got from keeping taxes a little bit lower for 1 year. And we would, and I could run that, but you might be paying 15-20 basis points more. And if you did that on the size of the issue you're going to have, that's going to, again, it'll be spread out over a 20-year period, but nonetheless, it would be, fairly impactful. That I would hope that that.
I know you can't run the numbers, Matt, but we would be paying that 1.4 million back 2 or 3 times over.
I would think that would be possible. Yeah.
Dan, did I ask the question right?
Yeah.
That's a good question. I enjoy that. I didn't enjoy that question. I appreciate that question. Marcia, I have a question for you. Do you know round numbers off the top of your head? And if not, can you provide it at some point about how much general fund would be available and still stay at 10%?
That'd be an easy enough thing to run if I pull the financial statements up while we're talking.
Okay,
But it's not much. But while we're talking on that, Matt, I just have a question on the mechanics of this. Would there be any benefit to, let's say we have, and again, who knows where it's going to stay, but let's say we have 2 million in next year for capital projects that we're going to pay for in cash. We find a savings of $500,000 this year. It's all going to come out the same in the end, but instead of having a budget that shows extra fund balance at the beginning of the year and using up 500,000 of fund balance, would we be better off kind of hiding the use of fund balance by taking the 500,000 extra this year, tucking it in the capital non-recurring fund, as transferring it in as an expenditure this year? So our expenditures still don't go up. We're just moving it into that fund, and then next year we have a balanced budget because we use the fund balance from the capital non-recurring fund. So, are you following that?
I follow it, and again, I'm not being a CPA, but I think that makes sense. Just from the inflows and outflows and with respect to the capital non-recurring, I think that would make sense and be appropriate. So I don't think that would be, I think that might actually work out a little better. But without seeing it, it would be hard to say 100%, but that does make sense to me. That pay-go, just in general, is an option in terms of, there's a lot of communities that might pay, a certain amount every year. And just to have that as, just to reduce that or pull it out of that fund, it's nice to have that flexibility to do so. So yeah, I think that wouldn't be bad.
You stated earlier, Matt, that you've been on the phone for 4 hours discussing this with other towns. Is there anything you can share as a general consensus? I mean, I know you can't put clients and this and that, but is there a general theme of how other towns are attacking these issues?
I think because of where everyone is in their budget process, you're literally, the conversation is almost identical. Some may have big bond projects coming up and some may not, but otherwise it's a matter of keeping the tax increase low. And how do we do that? Do we use fund balance? Do we not pay our pension? Do we lower the OPEB contribution? Is there a hit to pay-go? Is there any refundings? Like we talked about refinancing bonds. I know maybe not on this call, but when we did that in December with the town, and everyone's just kind of in the same boat. And then you layer on top of that, depending on the tax deferral or the interest rate option that you have from the executive order, is how do we manage the cash flow? So the conversation just takes a lot of turns typically, because there's a lot of things that you all are dealing with right now. But I will say that honestly, it's like the same type of conversation, because there really aren't a lot of other options that you have. So it's a matter of what fits best for your particular town. And again, a lot of it has to do with how much fund balance you have relative to your peers in your group. How strong is the pension or in OPEB, and what happens if you maybe reduce that payment, and that kind of thing, because it's really the same kind of fundamental conversation each time.
But do any other towns have a $63 million bump ahead of them in the next year or two? I mean, that has to factor into this whole decision now.
It does. There's some others that we have some big projects coming up too. And I think that's probably part of the reason why the maintenance of the rating is as important as it is, because if you do have those big numbers coming down the pike, you are probably in a position where you'd want to really make sure to hold on to that rating now more than ever, really, because spreads have widened to some extent, and that just translates into a lot of extra interest over the course of that borrowing.
Okay.
Piggybacking off a similar question to what Glenn had, there's lots of factors that, I mean, I looked at I remember the matrix of all the factors that go into the ratings and all the different weightings, and fund balance is one of them, but there's all sorts of other qualitative and quantitative factors that go into it. Since we have you, is there anything else that we should be considering during this particular budget season, qualitatively or quantitatively, not related to fund balance, to make sure that we're in the best position when we're ready to go?
Yeah, I think, there are a lot, like you said, there's a lot of different factors. I mean, a lot of them have to do with your economics and your debt profile and things like that, which we kind of, talked about a little bit. There's not a lot of other things that would really get put into that conversation with respect to the budget, because typically, it comes down to funding these 3 or 4 things that you do every year. The rating agencies kind of expect you to do at certain rating levels. And it's just a matter of how do we somehow modify that for this particular budget, perhaps, or 2, and still maintain the best credit that we can. So there's not a lot of other things that I could think of, with respect to that. I mean, doing what you can to keep your small businesses open and your taxpayers paying taxes. But I mean, that's that's, I think, kind of goes without saying. So
Okay.
I think
Thank
we
you.
covered most of the items, yeah.
Yeah, anybody else with a question?
I just have a response for Dan. We're about 335,000 above 10%.
Great, thank you very much.
Mark, Ricky, Brianna, Eileen, Steve? Nobody? Matt, you want to add anything, or you want to be able to get on and enjoy your evening?
No, I like I said, we're all in the same boat here, and it's going to be obviously a challenge going forward. But at least from where I sit, looking at where you guys are, thankfully you're in pretty strong shape, and you've had that stability, and you've gotten to that place where a lot of issues want to get to at the AAA level, and hopefully with good planning and good decision making. And hopefully things kind of turn around in the next, not too long. We should, be able to maintain things and survive this.
All right. Well, I thank you for your time and appreciate you coming on. I'd like to be able to call on you maybe down the road as we put something together for just the final, go over. I know, we can't hold you to anything, but just to set extra eyes on it would really help us out. We'd appreciate it.
Absolutely. I'm here to help.
Thank you, Matt.
So much.
Thank
you. Appreciate it.
All right. You got it. Thanks, guys.
All right, back to our meeting. Marcia, can you pull up on because you do that screen thing well, Dan's tree, so we could go through it now again a little bit.
I'm going to step away for 1 minute.
Yes, sir. We're just going to go through Dan's thing. It's not going to be.
Marcia, before you take the screen over, I just want to appreciate the fact that you seem to be with us from the Louvre.
Yeah,
You're
Marcia.
muted. Marcia, you're muted. Okay.
Yes, I did. I have a friend who is an arts major, and we went to the Louvre together. So I sent her a picture that gets some arts credit there. All right, where is my screen share? Share screen. Share screen 1. All right, here is Dan's decision tree.
All right. What we talked about for everybody here is Dan put this together. He walked through basic summary of it early. You can see here, we want to talk about the available 2020 surplus. Marcia showed us last week the point 2, how to flatline this out over a few years. We're going to look at 1 year, 2 years, like Dan has said. We need to finalize the available unused bonded capital as one of the ways to get the mill rate down. We need to determine the best use of unbonded capital. You can see the points listed. Again, reading down that the mill rate, if we like, is it sufficient? Yes, no, continue. Analyze the cost benefit of potential cuts, reductions to the expense lines and agree upon the cuts. Again, we go back to the mill rate, sufficient or not. Make top-down expense cuts. Again, another decision point. Point 10 is what we talked about tonight, the general fund. Dan asked a good question. How much are we over 10%? There's really not a lot of room over 10%, $330,000. So that goes into that decision point. We have to set the public hearing to discuss. We're going to have the public comments and review potential changes, review updated information, make any changes needed, adopt a budget, set a mill rate. So what Dan also did is break this down into milestone dates and meetings of goals of each meeting. So each of our meetings would be very productive. As you can see for tonight, we're going to talk to the BOE about their surplus scenarios. Ken posted his March financials, and he added 2 columns at the end of his March financials that show us the up to May 20th reductions as well as the school year reductions. We've been working with Rosa and the Board of Ed and her team. It's going to be a fluid thing. It's going to change, and she's going to continue to update us. Marcia's going to update us on the town surplus as well. We're going to look, Ricky's going to talk about some capital. We're going to lay out the possible uses of these surpluses and capital. Also, we've asked the Board of Ed as well as the town side to identify any cuts or reductions, and we're going to look at the cost / the benefit of that. interview, we had the financial advisor. It gave us his take on the drawing of the general fund. And then we're going to have the initial discussions on the desired budget results. Then if you go down, we're going to meet every Wednesday for the town people and for the people going to watch this. The next meeting, we're going to go through another set of questions and come up with a goal and a structure on how to handle this. As you can see, we're going to, any changes to the surplus, any changes to any executive orders. We're going to review surpluses, how to come up with a strategy, as well as a plan to soften this out for the taxpayers. You can see then we're going to have a meeting on 5/6. We're going to go through the same circles to make sure we've covered all the bases and to get the best information possible. 5/12, we're trying to hold a public hearing. As of right now, that's the date we're shooting for. 5/13, we'll have another follow-up meeting to the public hearing to discuss what we heard at the public hearing, any changes, any new information. Again, changes in executive order, anything possible to get the best decision. We're going to meet again on 5/20. We're going to discuss again changes, what's happened since the last meeting, any new thoughts, any new strategies, any new information. On 5/27, we're going to have a meeting and adopt the budget and set the mill rate, as you can see. So we have a plan, and Dan's laid it out very well, of dates, thought processes, and how do we get there. I think, speaking for the team, we're not setting a goal of a percentage of the mill rate. We're going to let a strategy drive us to a percentage, looking at all this information. And once that strategy and information and data drives us to a mill rate percentage, then we have the option of what are we going to look at? Are we going to look at maybe reductions, cuts, or using the general fund to possibly get to 0%? Or we're going to decide that this percentage is where we want to be, and that's how we want to move forward. I think these are what we're doing is we're taking in all the data. As we now progress further into the meeting, Ricky is going to talk about bonding, and he's worked with Marcia on the bonding process and what we have ideas on how to resolve that. Brianna has spoken with other towns or reviewed other towns. She's reaching out to other Board of Finances and other towns to see how they're tackling these issues. Marcia's going to speak from the town, and Steve is going to speak from the town side to see what they've come up with since our last meeting. And I think Rosa also has information from her last meeting that she could share with us as well. So for the town and people who are listening, is we are trying to gather as much information to reduce the liabilities on the taxpayers, but to remain stable across the next 2 or 3 years, to maintain our bond rating so we can borrow at favorable rates, and to ease the burden of the bump of if we reduce down, the next year increase isn't so large that we can't overcome it. We're looking at all options to make a smooth transition from lower the mill rate to getting to the $63 million bonding. Everybody in agreement with that?
The only comment I would make, Glenn, and I spoke to Dan earlier via email today, is that we haven't considered if this coronavirus continues in through next year, there are going to be areas where we're going to have additional expense. And we're dimensioning that now. We're working with EMS, fire, and police, and we'll have that for you next week.
Perfect, but that's part of Dan's tree of how we're assessing weekly. We're not really setting guidelines. We're accessing data weekly to get us to the decision point, right? I mean, that's the goal.
Right, agreed.
I mean, we don't have a predetermined number, is I guess what I'm trying to say. We're taking all the data and driving it to a number, correct?
Okay, I agree.
Glenn, I agree with you in general, except I'm having a hard time coming to grips myself with voting any tax increase from 6 of us voting that. So I'm, to say we're not at a number right now in my head, I'm at a number, and that number is 0. Not to take things away from the schools, not to take things away from Steve, but to find other ways to fund things. Hopefully we're allowed to vote at some point. I don't know, but that's where I'm at.
It's fair. I mean, glad you said that. Anyone else have a comment on that prospect before we move on to the next stage? All right. I would say let's move on to Rosa. Why don't you come up and give us your update, and then we'll move through this.
Okay. Could somebody just enable my screen sharing? I don't know if that's possible.
Yep, I'll be right with you on that.
Thanks.
And you are set now.
Okay. Okay. So I'm trying to just.
Rosa, I'm sorry, I don't want to stop you, but we do
No, go
need,
ahead.
as you're not a member, this is a public hearing. You need to say Rosa Fernandez, Chair of the Board of Ed.
Oh, okay. Rosa Fernandez, Chair of the Board of Ed. Thank you for having me.
Thanks, Mark.
All right. So I can update you guys on a bunch of different stuff. We've been working really hard to kind of identify really where we're at in terms of the schools being closed until through 5/20, but also where we will probably stand if they're closed even longer, which I still have a feeling that's where we're going to end up. But, you know, you just never know. I just heard Massachusetts is closed through the end of the year. So that's definitely a decision that will make some of this a little bit easier if we had that final information. But what I wanted to do was just to kind of keep continuity with what I had presented to you in the past in terms of our major budget issues this year and how that reconciles with our financial reports. So this slide that you have that is in front of you now is something that should be familiar to you. And as you can see, the issues with special education have, for the most part, remained, although the closures have affected some of those accounts, not in really dramatic ways. But I just wanted to keep these main numbers here in terms of how this exposure would appear had the closure had not happened. I just felt it was important to understand the effects of the closure as separate from that. So I just wanted to, and I will detail obviously the effects of the closure on later slides, but for now, I just wanted to sort of show you how this would look in terms of our major budget issue is special ed is still sort of being there. Now, if you look on this slide, this is the one that is probably more important to you. So our projected overruns with the special education are still fairly high. Our other, you know, pluses and minuses in our normal budgetary dynamics haven't changed very much from last month. But what has changed, obviously, is our shift to distance learning. And as I had sent to you previously, we are looking at a total savings, and this is just through 5/20. That's our, you know, what we know we're going to be closed until. A savings of, you know, over $600,000. And I have all that detailed in another slide if you really want to look at that closer. But the district-wide spending freeze that had already been in place, so that freeze is there, but obviously we are not going to need any further support from the town, and we'll still end up with about a $91,000 surplus. So that's what we know of for sure. Now, if the schools were to be closed until the end of the year, the big change obviously is that this shift to distance learning figure is now, you know, closer to 946 million. So what ends up happening then is a much larger surplus, so around 423,000. Yeah, 423,000. So in terms of what happens to the non-lapsing fund and the student activity fund, those are things that I think that we will need to discuss. And I have that sort of presented on the next slide. Does anybody have any questions up until this point?
Nope.
Okay. So here are possible adjustments that we had talked about, and we really felt that it was appropriate for to offset some of the things or reduce the budget for next year with things that are one-time purchase items, things that we can purchase this year and physically obtain this year, but of course that we could use in the future. So of those, we identified the things that you see on the top there. So our ST math program, that completes that rollout. The furnitures, for the 3 new sections at Center School. the BHS graphics computer lab. All of the things I have listed here are things that we had budgeted for, but we could safely purchase with the surplus this year as well. The
So,
ones on,
Rosa,
yep.
before you go, then, so what we're looking at is if we were close to 520, you had a surplus of 91,000 projected.
Yep.
So what you're saying is if you took that $91,000 now that you had in a surplus and you bought the top items at a total of 89,000, we could reduce next year's budget by 89,000.
Yes.
Okay.
Yeah, because all of these things were built into next year's budget. So yeah, if we had purchased them now instead with the surplus, then yeah.
Right. I just want to be clear that we
Yeah.
could just reduce the, not 90, but yeah, the 89,000
Yeah.
would reduce out of your budget, correct?
Yep.
Okay.
Yeah.
So on to the next items and thank you.
So yeah, the other things that we just needed to discuss, there are still a few things that are up in the air, and in terms of, additional expenses that we might see from this, we're unsure if substitutes are eligible to collect unemployment through the summer, and I don't know how long this is going to last, but beyond that. So that's the number that, we're figuring anywhere between 40 and 50,000 if they're somehow able to collect longer. I would hope that, that number works out more in our favor, and not because I don't want, people getting paychecks, obviously, but substitutes wouldn't normally collect a paycheck. So I don't think they would be eligible, but, rules have changed through this. So that's something that's, that we need to keep an eye on. Health
Rosa, can I
insurance.
stop you there?
Yeah.
And I mean, part of that unemployment is because of this ESS issue, no?
Yes. So our substitutes are employees of them, but they haven't been working for that company long enough
Right.
when they were unemployed. Yeah.
So I'm looking at the contract for ESS and I'm, very confused. It didn't go through the town's purchasing agent, right? Ken Post signed it, not our town purchasing agent.
Okay.
I mean, this thing is it's a horrible contract to sign. Some of the things in here are crazy. And then it goes through the end of the 2023, June of 2023 with a 3% increase for them every year. They get a 31% markup of everything we're paying the teachers. I guess this isn't the time for that. I don't know.
No, it's not the time. It is a concern. Rosa and I are right levels.
Well, okay. As long as, we hired a purchasing agent for the town that does half the pay is from the school, half the pay is from the town, even though more of his job is supposed to be done from the school. That's okay. But we don't even utilize him for a major expenditure. And it was a shock to see that they were hired. Anyways, all right. You're right. I'll stop on that.
I will find out more information for you, or I'll dig a little bit deeper on that, and hopefully we can touch base again.
Thank you.
Yeah, sure. The health insurance number, I just want to quickly touch base on. That number has been, sort of hopping around a bunch. It does look like there's going to be a delay in terms of the new premiums, but then there's going to be a jump. So right now, it might end up costing us more money next year. That's still sort of something that we need to keep an eye on. We did talk about, I know we, in our joint meetings, we had talked about the cafeteria fund use, and currently as part of the $817,000 in reductions that we were trying to find, we had budgeted in $30,000 to pay the monitors from the cafeteria fund. In closer looks, we feel that it's probably safe to increase that to 60. So an additional 30,000 is what you see here in front of you.
Sorry,
And yep, go ahead.
The health insurance, that $6,000, that's just additional people being added because of change of, spouses losing jobs and that type of thing, or is this that 3 months?
Yeah, so, well, there have been, I think just one additional person added to the plan, although, I don't know how long this continues. is, you know, if that number might potentially grow. So that's something that we're keeping an eye on. But in terms of the rate increase is actually delayed because of all this. So we actually might see a little bit of a savings, but then it's going to kick up. And, you know, we thought we would actually see some savings. You know, we had talked about that at our finance committee meeting, that we as potentially seeing a savings, but then when Ken did the calculations, he's like, no, it's actually going to cost us more as of now. So, yeah, so.
I think, Eileen, that was talked about with Marcia as well today, and I spoke
Yeah.
with Rosa, and I think that in that case, Ken looked at an email and tried to be very positive on it, and it had a positive tone to it, like your meeting had. But I think when he got that email that day, I think when Rosa followed up, it really does net a nothing of a savings and possibly a small increase.
Oh, bummer. Okay.
Yeah.
And can I jump in here? You also have to remember on health insurance, we just hired an employee after somebody retired. We went from one person on our health program to a family. That can change throughout the year. And those can be significant numbers. So you're taking a guess at it.
Right.
Right.
I guess my point of this thing is Ken identified these savings in the subcommittee meeting because he was actually really looking to drive these savings, and it didn't materialize. And I don't want to stop us from attacking or saying, why did we mess up on something that fast that happened on a daily basis? Because this is what we're asking for, where we could get savings. So I guess that's
and that was my point. These change, they can change weekly.
Okay.
Right.
Go ahead,
And
Rosa.
if I could just jump in, this is Marcia, that we got an email from the health when we asked specifically about, is there going to be a delay in the increase? And the answer was yes on that email. It wasn't until Fern followed up with the second person that we said that said, hey, yeah, that we're going to keep the rates flat for the first 3 months, but we're going to increase some extra in the last 9 months. So they were not providing very helpful information. They weren't giving us the whole story.
Thank you.
So I don't think we're going to get us real savings there.
No,
We're not gonna. That's what we're deciding. We're not gonna. Don't count on it.
Yep.
Right?
Nope, that's fine.
Go ahead, Rosa. Back to you.
Yeah, so you know, the last 3 things that I have bulleted here are just things that we, you know, need to consider. We had originally talked about you know, being able to safely withdraw 52,000 from the student activities fund as a potential, you know, way to solve our special ed issue this year. But even if we don't do that, we're going to end up with a surplus, and taking the money out of that account is a one-time benefit. So it might be beneficial to have that benefit be next year as opposed to obviously this year where we don't need it at all. So that's something that I think should be considered. And then, you know, the last 2 items are really just, you know, something I think that we, you know, collectively need to, you know, figure out in terms of what is the best way to utilize or hold on to some or all of these funds in terms of, you know, the underrun from last year, which we're not going to need, and, you know, the potentially wide ranging, you know, surplus that we might have this year, or that we are going to have this year. But it, you know, what that looks like could be, you know, very large, or, you know, this 91,000 number.
Right. I actually appreciate you use the word collectively, because I think that's a key word, that we all have to figure this out as a plan. I mean, Marcia and I talked earlier, you could have numbers on the paper and have them out there, but it doesn't necessarily dictate a plan. And I think this has to be done collectively on the best use of the 52, the 177, and the 92 to 423 as a group. Now, I think on the student activity fund, you really got to work with Steve and Marcia on that, because I think that's an outside account and it has a revenue instead of an account. And Marcia, I think you could speak to that.
So on the student activity fund, that right now, the way that works is we've got cash in there as an asset, and we've got an offsetting amount as a liability. Now that we've identified it as as not belonging to the children, I think we don't have an option of saying, well, we're just going to keep it as a liability for another year and fix it the year after. I wouldn't have done that as an auditor. I'm sure our auditors aren't going to allow that. But what we could do is we're working through this non-lapsing fund concept of setting that up as a true separate fund. We could throw it in there. So it's just a manipulation, not a manipulation, just an accounting that we could throw that into the non-lapsing fund and have the same effect. So I would say we still want to recognize it this year and just make sure we do the accounting right so it's got the same effect. The same with the 177. In the past, we weren't putting those into separate funds, and we've talked about it. So when we have a surplus, just like we said, maybe we tuck some into capital non-recurring, maybe we take 177,000 and tuck it into a non-lapsing fund. And Eileen and Bob and I are going to meet and talk about that non-lapsing fund. But again, just account for it a little bit better and proactively than we've done in the past.
Yeah, and because this is all sort of in looking through the lens of the fact that we did have a huge special education issue, and that still really was a very a very prevalent part of where we are now. This number, obviously our surplus could have been a lot higher had that issue not happened, but I do just want to I think it would be beneficial to keep that in mind in terms of, the very real possibility that we will have large needs for those funds. Who knows, even next year. So.
Okay. Let's roll on. Next one, please.
Yeah, so this is just the detailed impact of the school shift to distance learning. And this is basically what you guys have in the financial report. I just took everything else that was not affected by the closure out of it. So this is just the detailed summary of that to show you how we ended up at those particular figures. So I didn't know if there were any of those that you wanted to specifically go over, or if there were other questions about our potential reductions for next year.
Rosa, this is Dan. Great job, by the way. This is very responsive. I appreciate it.
Sure.
As opposed to just watching the news, do you guys have any leading indicators on when a decision might be made as to the future of the schools for the year?
Unfortunately, I feel like the way Connecticut is I don't think we'll know until maybe mid-May at the earliest. I think, they just seem to make a decision, and that decision is just, sort of a hold on until we can make another decision type of thing. So,
Can I jump in here? In my conversations with state legislators and management and the governor's office, I'm reading between the lines that they're leaning towards keeping the schools closed. That's my guess. I could be wrong.
Yeah, I mean, I would probably lean that way too. Yeah, so.
Okay.
Thank you.
Yeah.
I think that part of this process is that Eileen's working closely with you now on this. So if we have any questions for next week, we'll run them through Eileen and let her bring them up. Eileen, are you okay with that?
Absolutely.
Yeah, that'd be great.
I think that as a board and part of Dan's tree, we look at these things and we can ask the questions on anything and going forward. So, and run them through Eileen.
Mm-hmm.
So, all right. So we're back to, well, did you go forward or backwards? That screen.
I just went back to this slide. I thought this slide was more sort of appropriate to the conversation, but.
Is that your last slide, Rosa?
That was the last, yeah, that was the last slide.
Okay.
The only other thing I did want to mention to you guys is that in terms of, the boys locker room project, and I know capital is going to be discussed as part of your And looking at Dan's decision tree, I was like, well, maybe we need to like move some things up. So after I spoke with you, Glenn, we are going to have a special Board of Education meeting next Wednesday, specifically to discuss alternate options for the boys' locker room. So, and hopefully we'll be able to maybe, I don't know, get some a firmer understanding of what we need in terms of keeping our accreditation on track and perhaps not having to report anything to NEASC. So ideally though, when would you, I know you would probably like us to present to you guys, more sooner rather than later, but I think our meetings, our Board of Ed and Board of Finance meetings conflict the first week in May. So I don't know if, there's
Why don't
some
you look and see what works for you, right? I mean, come back and see what fits. Can you have your meeting earlier? What time is your meeting next Wednesday?
5 o'clock.
Okay, so Eileen, can you be part of that by chance?
Yeah, I believe so. I don't think I have anything for work at that late.
Okay, so let's take it from there. Rosa, you and Eileen will be at the meeting, attend the meeting, and then Eileen, maybe you can figure out where to fit it in. How's that? Into our meetings. Our meetings, right?
Yep.
And
When is potentially too late to really have you guys, be able to really, have the information that you need?
I think we can go, not next week, we can go the following week. Dan, I mean, you're the one that really put the tree together. I mean,
I mean, the goal is to have something as final as possible by the public hearing on the 12th.
right.
So
okay.
the meeting on the 5th is, or the 4th, the 6th, I guess it is, May 6th is when we're going to try to finalize everything.
Okay, so
Really,
that's the meeting.
Ideally, it'd be next week.
Yeah.
All right, so that day, May 6th is the day that we have a regular Board of Education meeting, so that would conflict. And if we're not meeting as a special meeting with the Board of Ed until next Wednesday, then we almost need to move it up even further.
Yeah, I mean, ideally, it would be next week that we would.
Yeah.
Yeah, if it's that important, I mean, we're having special meetings every week.
Yeah,
So you guys, I'm sure, can do the same.
Yeah.
Rosa, can you also just make sure that you guys are also just looking into what impact it would be to just hold off a whole year on the locker room project?
Yeah.
To cram it in 2 weeks and make a
No,
decision on
definitely. Yeah. I think, now that, things are changing and you guys have to reach a decision, we need to look at things a little bit differently. So
Yep.
yeah, we can
And
do that with Eddie.
Right. I agree with Rose and I agree with Ricky. If we can show the NEASC that we have a definitive plan to address the locker room and we'll fix anything that's, we can this year, but we need to put together a plan. I think they would accept that. Don't you think, Rosa?
Yeah, I do.
Okay.
So, and we're going to have, Mark Belanda, the principal of BHS, at our special meeting so that we can, talk to him a little bit more about the process and what's really, really needed, so that hopefully he just doesn't have to make a report. So we'll know about all that. So, I mean, that's basically it from me, unless, you guys have any questions.
I think to summarize, does anybody have any questions before I summarize? Hearing none. Okay, so as a board now, we have to decide if they're looking at the 91,000 in surplus, do we want them to consider paying the 89,000 ahead? And this isn't a tonight's decision, this goes in the decision tree, and reduce the next year's budget by 90,000. We have to also discuss the 52,177, any other surpluses or the other items to discuss. And I think then we have to come back to questions with Rosa. I think the other thing we're looking at is you found the 30,000 that you've been able to do for the cafeteria fund. I think that's got to be an ongoing process in this, where we're trying to get to the end goal. As can you look at other accounts? And I know you are. I'm just saying it for everybody hearing is you guys are looking at line items of saves. We thought we had savings on the health insurance line. It didn't come to fruition. We're looking, and your group is constantly looking at that, correct?
Yes. Yeah.
Okay. I think anybody else for Rosa now? No.
Rosa, aside from the 89.5, are there any other items that were being cut, like that, are just things that we always just, textbooks and desk and little rinky-dink things that always seem to get cut and pushed out to the following year? Or is everything else that's being cut kind of, it's not necessarily going to be anything that's pushed out?
I had asked the question about, and Marcia actually was able to provide some clarity too, in terms of some of the things that, I was hoping we'd be able to just sort of stock up on, so that maybe this, $90,000 number could be even higher. But if it's sort of recurring things that we're continually buying, textbooks are not just like sort of the old school textbooks, but they're more like workbooks that we have to continually buy every year. Those are things that we can't sort of buy in this fiscal year for next fiscal year, because we'll have to continually purchase them anyways. But yeah, so I don't know if that answers your question.
Rosa, what about the classroom libraries that Bob was talking about at the meeting on Monday?
Yeah,
I don't
the
know.
classroom libraries is going to be an ongoing discussion, but the only problem with that is I don't think we're going to be able to sort of get you an answer in the time frame that you need it. So the classroom libraries are sort of specially curated collections that include they have to cover like a wide variety and range of topics and at different reading levels, and so I think they're selected very carefully and intentionally. So it's not something that we have like just a list of, and Dr. Ruby can just go out and purchase them because they're already sort of sitting in her cart type of thing. Right. So we're looking into that and seeing if there is any of those things that we can do for next year, but I don't know if that sort of list and what that's going to cost is going to be available by the time you guys need to make a decision. Okay. Yeah, so that's a problem.
And just to clarify that the way we could put it in this year's budget is the goods and services would have to be received this year. So if we did get workbooks, even though they wouldn't be used until next year, if we physically had the workbooks here this year, we would be fine as long as they're in-house by June 30th. If we were to say, oh, well, let's pay all of next year's electric bill, that we couldn't do. That services are probably something we could not play with, but goods that we could physically have in-house at June 30th, we could do.
Right, and I think that was probably part of the problem with the classroom libraries too, is can we get them all in time? So yeah.
For those items, aren't we kind of just chasing our tail there? Isn't it, whether we do it this year or we use it as a savings towards next year's budget? I mean, the impact is going to be the same regardless.
Yeah.
That's correct.
Right, but it goes along, Ricky, it goes along with your one-off theme, right? What can we pay for that's a one-off that we don't have a bump that doubles next year, right?
Right.
So it follows a theme of the one-offs, like.
But it'll also, if we keep it on the next year's budget, it could potentially help the increase further in future years, because we won't need it, so we're going to need less of an increase going forward. I don't know.
I see what you're saying. You're just sort of like pushing the increase further down the road, right? Well, I mean, if we buy this year for next year,
you would lower the expense. Yeah, you would lower the expenses, thus lowering the mill rate required for it, rather than covering it with the cost for next year.
I think the
year after that, you're gonna ask for whatever your increase is. It's gonna appear even higher if we cut that out of next year's budget.
Oh, right. Yeah. No, we're on the same page. Yeah, the things we identified here are things that are not recurring. So there are things that we're only buying once, and so therefore wouldn't create an increase the year after.
Yeah, I mean, I guess this is a point of discussion is does it make more sense to have the increased expenses with zero mill rate impact for next year's budget, or try to take care of it within this year and just lower the expenses But
Right,
again,
but
the
these
mill rate will
expenses
be
don't come back
unaffected
the next
either.
year, Ricky. These
What's that?
expenses won't come back in 2022. These are one times, right? So
Right, right.
flattens it out, Ricky.
Well,
Can I jump in and ask one question of Rosa?
Yeah.
Sure.
Rosa, we're looking at on the town side, if this pandemic continues or reoccurs or comes back in the fall, we are looking to, and I've got to say this, we were not prepared for this pandemic from the terms of PPE, protective equipment.
Mhm.
We had nothing in the budget. We had somebody in the building who got the coronavirus. We had to clean town hall. It was very expensive. Have you guys started to look at what supplies you need for your staff to keep them safe? And I know if it gets really bad, you probably close school again, but to keep the buildings clean and to have a higher level of monitoring of that, those are going to be expenses I think you probably want to look at. Is that
Yeah,
correct?
yeah. No, we have looked at, potential areas where we might see some increases, and I think that that's probably one of them. In terms of how we'll practice that is not something that that I know of that we've discussed yet. I'm sure those conversations are happening at the building levels, but I don't have any information on that as of yet.
Okay, so what I would suggest here is that we get Jerry to look at looking at our buildings, and let's say we had, God forbid, 20 or 30 cases in the high school. We had to clean the entire high school,
Mhm.
top to bottom, a deep clean like we had to do in town hall. What would that cost? At
Right.
least have those numbers available for the Board of
Well,
Finance to
and
consider.
then remembering that FEMA is supposed to cover 75% of that.
Correct,
So
correct.
get the number, do the math.
but it's good to know those numbers ahead of time, don't you think, Mark?
Always is.
Okay.
But one of the things
Rosa?
I'm thinking of, Rosa, we keep talking about non-recurring expenses, but one of the ideas, and I'm going to use the example of cafeteria tables, right? I think you spend $10,000 per building on cafeteria tables every year. Does that sound right?
Yeah.
So if you pre-bought those next year, again, this is just this one item, instead of having the mark come up the year after, we break it down over 3 years. So you buy them this year, but you still in next year's budget, you only account, for a $6,600 savings, and then it's a $3,300, add each year. So it wouldn't hit all in 1 year, and it would be a way to pre-purchase some more stuff this year. I'm really looking, if school gets canceled for the year and we have the 400,000, to use some of that cash, more ways to use some of that cash now that gets, creative in order to save money for the budget.
Yeah, no, that's a good idea. No, we'll definitely keep looking at all of that stuff. Yeah.
It'd just be a way to flatten the curve on future, big bumps in it.
Mm-hmm.
Anything else for Rosa? All right, on to
All right.
Ricky. Thank you, Rosa.
Yeah.
Thank you, Rosa.
Thank you.
Marcia, could you share the email that I had sent out yesterday? So I was tasked with going through the capital plan, and problem with that task is the 10-year capital plan. There's no priorities set in the capital plan, and as you guys obviously know, when we go through the process, we don't always approve everything that's on the capital plan. So it's hard to say, oh, we can fund this, we need this, we don't need this. I mean, we just don't know what's going to pop up. Sorry?
Sorry, I forgot I was not on mute.
Oh, no worries. Marcia, feel free to jump in anytime too. So I kind of changed course and looked at kind of, what we know to be true is that, well, quote unquote true is that right now we have town side projected savings about $500,000, and then the education side around $91,000. And my thought was, how can we apply that to the capital? And also we have a total unused bonded capital or capital non-recurring of $387,000. That's both on the school side and the town side. That's at our disposal. So the first thing that I looked at was to consider. Well, I asked Marcia to ask the department heads if there was anything in the bonded portion of the capital plan that had an immediate need. And the one thing that came back was drainage for the baseball fields, and that was set at $261,000. Again, but for this exercise and for this proposal, I just decided to say, okay, well, I wanted to see what the impact would be if we could use that full $387,000 to reduce the amount of cash that we would use towards the capital, the current capital plan. And I felt the best use to place it, even though it doesn't really matter, was to offset the cash needed for the paving, because we're already currently bonding portions of it. So I don't think it would look as flimsy if we went, in recorded history, 3 years down the road, and we look back and we saw that we used 20-year bonds to pay for 3 police cars. It just didn't make any sense. So that's kind of just, just to have a logical reason as to why I did it. That's what my thought process was in this exercise. So that lowers our expenses by $387,000, also lowering our required tax levy by $387,000. Then with the remaining $591,000, just seeing what the impact would be if we flip that to the capital non-recurring, as Marcia said, to try to avoid transferring it at end of the year into the general fund and then having to take it out of the general fund again just for this, knowing that we need it to pay down the taxes for next budget. That lowers our levy again. I think the total levy is lowered by $978,000, and that gets us to a mill rate increase of 2.09%. Total mill rate 29.75. And just to kind of, I figured the question would get asked of what it would be to get to a 2% mill rate increase. And that's another decrease of $58,600. And if we wanted to go all the way flat, it would be another $1.4 million reduction. And again, this is more just so that we could maybe put a stake in the ground and say, okay, here's a starting point, and then we can just continue to make adjustments from here. In terms of flattening the curve, my thought process was rather than holding on to the money or to the excess funds, let's say we have an extra, the extra $330,000 coming from the schools because the schools are close till the end of the year. Town side could potentially have another $100,000, $200,000 in savings. Maybe not, but let's say we have that $330,000. My thought process was to actually put all of that into a contingency. That way, in case pandemic does revive itself, we would have that so that we wouldn't have to go to the general fund for anything major up to another $330,000. If we don't use it, we can still push it next year into capital non-recurring in order to lower the curve. And we can push that out for as long as we want to in capital non-recurring. So that was kind of my thought process of where we could get to a comfortable place to lower the mill and then still use, if there's anything in addition to what is currently known now, to be able to flatten the curve. So I open it up to kind of hear your thoughts on that.
Marcia, you've been working with Ricky. How about you speak to it?
I really liked his idea that, again, the more we can do to not pull from fund balance or to manipulate it so it's not clearly pulled from fund balance. So I really liked his idea, and I think we can, when we start talking, we'll find your $58,000 for you.
I agree with Marcia and Ricky.
I was going to ask you next, Steve, so thank you.
Sorry, I
You want
didn't
to
mean
comment more? You sit in the big chair. You want to comment more?
No, I think this is a really good idea. Some people would consider this perhaps a slight manipulation of how we do things, but given where we are and what we're doing, we can achieve a result we need without harming the town or the schools. And it's simply a way to move forward that we can adapt to and recover from very quickly, I think, in the next year or so.
Anybody else want to comment to this? Nobody? All right.
I'll
So
consider
thanks,
the perfect
Ricky.
proposal then. Thank you.
Thanks, Ricky, so much. Appreciate your thought process and working with Marsha. Marsha, again, appreciate you working with Ricky and the rest of the members on our team. Since we rolled into Ricky said some savings, let's roll into Marsha and Steve's side of this and what they've come up with this week.
Okay, I'm going to let Marsha give you an overview. We've done what we think of where we can save funds. Again, some of them are, one time and stuff like that, but I'll let Marsha go through what we think we can have. There are some areas where we're still not sure whether we're going to save money or spend money. It really depends, like with Parks and Rec. If we open the programs for this summer for all the kids, do we make money? Do we lose money? Things like that. So Marsha, go ahead.
Did we lose you?
No, I just muted myself so you don't hear my dinner order again. So we have reached out to each of the departments again, and they said, gosh, you just reached out to us last week, but we're going to reach out to them every week so we know what's going on, what's changed. We don't want any surprises. And so we took a look at the current year budget, and these are the things that are new since last week. We had an executive order that says the primary for the president is not going to be until August. So that's what's giving us money, that we had money in there for the people for that primary, plus the referendum. And it doesn't look like the referendum is going to be before June 30th for the capital. So these are the savings that resulted from that. I talked to Ryan this morning, the registrar, to see if we should be adding this to next year's budget. He does, he already had a primary in there for August in case there needed to be one. And he already had, he has one extra referendum in each year for whatever comes up. So right now we'd be good. If we have any extra referendums, he's going to need to change his next year's budget. But for right now, it's good. That Social Security, I just haven't had the chance to calculate how much the savings would be if we don't have any programs for Parks and Rec. Like we usually have the summer programs starting, and so there will be a savings there, because some of the programs start Memorial Day weekend. The unemployment, that is going to increase. Right now we had 2 people on unemployment, and from what I understand, that they will be getting extended unemployment because there are no jobs out there. So that will be increasing. We've got a 3rd person on unemployment that it looks like that person lost their full-time job. And the way it works is that you look at the base and who were their employers. So even though they were only part-time for us, it's hit our unemployment costs. Workers' comp, we had good news there that they were charging us extra money in an audit premium, about $24,000. And I had Lori, our payroll clerk, go through and audit their audit. It didn't reconcile that they had one of our employees in twice and an extra figure in there. So that saves us $10,000. one of the things that we can look at is the OPEB reserve, and I talked to Matt about it earlier today, that we have 200,000 that we pay each year into the OPEB reserve. That, as Steve had said earlier, our liability was 27 million. There was a new way to account for it. It went to 18 million with accounting rules and some changes of ours. And now it's down to 12 million because OPEB is other post-employment benefits. It's handled just like a pension. It hasn't been on the accounting rules, only put it on our books maybe 10, 12 years ago. So people weren't paying for it, paying anything towards it. It's for health insurance that we pay employees after they leave, after they retire. So the long-term employees are getting paid some health insurance benefits. The new employees, like me, that's gone. That's gone. And that saved us a few $1 million last year. And so my question to Matt was, all right, we brought the liability down by a few million. What difference does 200,000 make? Or even if we just cut it by 100,000 and just paid half of it in. So that's something that's on the table to look at. Police, I talked to Chief Purcell, and right now no one's taking vacation. So there's not a lot of overtime to cover. However, they can carry this vacation time over this year. So it might affect next year that he'll have more overtime there. And all this may go out the window if there's any COVID cases that go through and they've got to take people out, then that's no longer a savings and it's an increase. EMS, that Steve had talked to them and their revenue is down. Now their calls are down for regular cases. Well, that might mean their revenue is down too, and that offsets some of what we pay them. So they're going to pull those numbers together. We told them we wanted to report it next Wednesday, so they're going to get it to us early next week. So of them,
Marcia, can I jump in there real quickly?
Yeah.
I talked to Eric Sullender today, and the number of ambulance trips we're making right now is down significantly from last year or the year before. And every trip we make, we lose money. But the problem is our expenses are fixed with the EMS for the most part. So if they don't make a trip, they don't get to bill insurance. They don't get to recoup some of that money. So they're going to be looking at that very carefully over the next few days to see where they think they are going to end up and where do they think they may be next year. Because remember, when you look at their budget, there's a net offset. Here's all their expenses, and then the insurance money comes in on the bottom. So their expenses could actually go up to the town, not in actual dollars, but in less reimbursements from the insurance companies. I'm sorry, go ahead, Marcia.
So what we've quantified in just this last week is an additional savings of about $42,000. And it'll be higher than that because we have some of these things, the ones in gray that we don't have in the formula. Any questions on potential additional savings for this week, this year?
I'll admit I zoned out a little bit. Can you, the timing on the OPEB discussion?
Sorry, what's the question?
So the OPEB, we would have to, we have money in this year's budget that if we are funding it, we fund it by June 30th. That, so it's, we won't fund anything until we hear from you.
Yeah, all right. All right. So that's a variable that we can play with next week.
Yes.
Gotcha.
And it's in this year's budget for 200,000. Yes, we can play with that.
Okay.
And then so we looked at next year's budget that Rich Saluga pointed out to us that we've got that the charter says that the salary is 5%, so we would have to increase that because I'm sorry, I missed that. that tax litigation, it's not a reval year. So in total, we thought on the selectmen's budget that based on the history we've had, that the legal fees have been going down substantially, that maybe we could pull 25,000 out of the legal fee budget. There's a lawsuit that we've got fees in for next year, and it looks like that might be settled. So we might be able to remove that. These are all things that we know now that we didn't know 60 days
We're losing
ago.
you, Marcia.
All right. Can you hear me now?
Yes.
Okay. For IT, that we had some computers in. Well, as part of all this, we bought some laptops. We can take the computers out, and we have this great Zoom product. We took out Microsoft Teams for now. For employee benefits, we have unemployment that it's going to be increased. Again, we had talked about that for this year. The same issue. For health insurance, I used the information that I had as of the May billing to project next year. And so with the different changes of people in, people out, I realized I had one of the WPCA is on our insurance and they increased an employee and I hadn't pulled that out of ours. So I think we can get another 60,000 of savings. And that brings us right to the midpoint. So someone goes up, we're going to be over budget, as you know, if they change their coverage. And we have had that on the Board of Ed side where a spouse has lost their job. And so now they've jumped onto our insurance. So this, you know, we may talk more about insurance next year. The OPEB contribution, that's the same thing. It's in the budget next year for in the 200,000 again. The EMS is the same discussion that we're having now. And then the Emergency Operations Center, that's where we're putting the COVID costs. Steve has asked the departments to pull some numbers together. It's kind of dicey that it seems like a really good idea to have a 3-month supply of the N95 masks and things on hand, but they have expiration dates, so that we're still working through that. The senior center and then the Parks and Rec are the same issues here, that they charge for their classes, and the concern is that, you know, we open things up July 1st. Those classes aren't going to be filled July or August or September. It's going to take people a while to get comfortable getting back to them. So we may have partially filled classes that would cause us to have to support them more with general fund money. And then social services, that in talking with them, there's 2 concerns that they have, that there's a big influx already of people looking for social services assistance, and they had already asked for an additional part-time person, which they did not get. And then the other one is that they use a lot of volunteers, and apparently social services gets their volunteers from the senior center, that so they're all older, and do we want older people dealing with the public right off the bat?
Marcia, can I jump in there? You know, our needs and our demand, and we are always going to take care of our residents. The demand for our services from social services and the food pantry has gone from 15 to 20 families per week to 60 to 85 families per week. We have a line, I've never seen it before. We have the conga line in the town parking lot once a week for families who need food. Now, we're able to manage it now, but we may need to add people once the senior center reopens. Ellen and Amy, Chief Purcell has been over, Jason D'Souza has been over, helping direct traffic. But if we reopen Town Hall and the senior center, we may need to hire more people. And what I'm really concerned about, and I think Marcia agrees with me on this, is we can't have people working in the food pantry if this coronavirus really hangs on through the fall. And by that, the reason being is that most of our volunteers are over 60 for that. So we may have additional expenses. And I'm very concerned about that. Okay, I'm sorry, Marcia, go ahead.
And with all these expenses, we're working on reimbursements that any and all grants that come across the desk, we're working on getting them. That we filed our first grant report on Tuesday. That was for the Department of Public Services. It had to be expenditures that were completed by March 31st, and things were just starting to be ordered and things. So it turns out the request was for about $1,400, but it's $1,400 that.
Can I jump in one more time here? On FEMA, I'm sorry, Marcia, I don't mean to interrupt you, but on FEMA, you have to prove that you've exhausted all other possible sources of money before FEMA will consider the expense. So for example, today, some grants came into us, some possible grants came into us for food and other things. We have to apply for those because FEMA keeps track of all this stuff. We need to apply and get turned down from them before FEMA will pay. Now, the one grant we saw today for food, and we've spent a fair amount of money on food already, thanks to the Brookfield Recovers Fund we created 2 weeks ago. We've been able to pay for food ourselves, but this grant today will pay 100%. Well, of course, we're going to apply for it. So we pay and get back 100% because FEMA is only paying 75. But if FEMA finds out that you had another source of funding for any particular expense, they will deny you 100%. And Greg Dembowski's doing a great job on that. I'm getting a little off track here, but go ahead, Marcia.
That's okay. And then we had a contingency in there, a large contingency for the union contracts. We have 2 union contracts, and we're expecting both of them to be we had thought that at least one would be extended into next year, and it does not look like that's going to be the case. We can't quantify that yet, but as soon as that's signed, we will work to quantify what the savings. We think there's going to be a savings because we've got legal fees in there. What the savings is going to be, and hopefully report that to you in the next week.
Yeah, we're very, may I jump in again? We're very, very close on one contract that we're working with. We can discuss it if you want in executive session. We think that will settle very, very quickly, but the other one is dragging out for a while. So we're a little concerned about that, but we think we'll be able to settle it. Now, if we do be able to, if we're able to get both contracts settled, that's good, because as Marcia showed before, we had $20,000 in the budget to go to arbitration with one of the bargaining units. And we don't think we're going to need that. And we've taken that out, but we'll see. It's a moving target, but I think we have a good chance.
And that's this week's update on any effects that we're seeing for next year, as far as, and these are just the portions that are based on more knowledge that we have. We didn't look at, we did look, but we didn't report here anything that are cuts or anything like that, just refinements in our 60 days since we did the last one.
Okay, so the 109 is what you're saying has been quantified. but you have a lot of increase, decreases on those. Are you confident they're going to balance each other out, and you can achieve that 109, or where do those unknowns fall, like in your gut feeling?
I think it's too early to say where we're going to end up, Glenn. My guess is we're going to end up having some savings, but I don't want to commit to it until we've been able to talk to EMS. We've been able to go through these things a little more carefully, and we'll have that for you by next week.
I'm in agreement, but are you talking the 109 that you've identified, or are you talking the decrease, increase unknowns, or the whole number could change?
Both. The whole number could change because some of these are going to go up, some are going to go down, and we're going to give you our best guess as to where we think we're going to end up with them.
Okay.
So Steve, you think next week we'll have a higher confidence interval, higher confidence on a number that we can at least pro forma?
Oh, yes, absolutely. Yes, yes.
That's okay. All right.
And we'll tell you where we don't have a confidence level and give you our best guess.
Got it. That'd be great.
Now, the OPEB contribution, though, stands on its own, doesn't it?
Right.
I'm sorry, say again?
The OPEB contribution stands on its own, right?
That stands on its own. I honestly believe my personal preference right here, and this is my recommendation to you, is cut it 100,000. We could cut it 200,000. And based on what Matt has told us in the conversations we have with him today and earlier, it would not make a big difference with the rating agencies as long as we have a plan to continue to build that in the future.
Okay. So that would be a standalone, though. We could talk about that as a separate
That
issue.
would be a standalone, has nothing to do with the rest of the budget.
Okay. Any questions for Marcia to this point from our side?
No.
Nope. Just that there's lots of open items that our decisions hinge on.
I
And we're
agree.
gonna- We're going to try to close them down for you by next week.
Oh, yeah, I get that. Yep.
But I think, Dan, that's sort of where we were at, though, knowing that, even with your tree, right? We were
That's
grabbing.
exactly right. That's exactly right. I'm not complaining about anything. I'm just pointing it out. I completely agree.
Right. So, I mean, again, that's why we're meeting every week. That's why we've developed that structure to grab information as we can and not make a decision, but keep asking questions and drilling down, right?
Yep.
I mean, if you were to tell me a week from where we were last week, these numbers are coming in line. Like I say, Steve and Marcia have a structure. Rosa had a structure of where things were lining up. Now it's refined time, right?
Yep. Yeah. So, I mean, ideally, I'd like to start building a budget next week that we continue to narrow down over the coming weeks. That would be my goal.
Well, that's what I had in my next statement, to be honest
All
with
right.
you.
Sorry about that.
No, you're good. You're ahead of me, which is okay. I was going to ask if Marcia and Ken, with Rosa, and Steve's blessings, obviously, can they get together and give us a scorecard for next week?
Perfect.
Of what
Yeah,
do we know?
I think that's very possible. We've been working with them very, very closely. So I think we may not have all the answers, but we're going to be a lot closer by next week.
Yeah, that's what I'm asking for, Steve. A general scorecard. Almost like Dan said, real confident that we can achieve these. These are, a work in progress, but we have a high I don't know how you break it up. You and Marcia and Ken and Rosa can figure that out. On what you want to present.
Marcia and I have been talking about it today, and what we thought we would do is tier 1, tier 2, tier 3. Tier 1 is these are real things that we can do. Tier 2, these are good possibilities, and tier 3, we're kind of out there a little bit on the edge, a little more risky. Does that work for you guys?
Works for me. Anybody else got a comment?
And the part that we haven't talked about yet that we do want to get back to is revenue. That the selectmen switched so that we're going to do the deferred revenue portion, and from a risk point of view, I think that's much better in that we'll know who is going to apply by July, because there's got to be applications and it's got to be by July 1st, because our biggest concern, and Steve has asked me to say, what is the worst case? Well, the worst case is everyone takes that you have to be have your income cut 20% if you're an individual or 30% if you're a business. And we have to have the cash flow for them to not pay their taxes until October 1st. So that's also a big thing that we've got to consider in all of this, that what happens with that revenue being pushed back? Do we have that cash flow? If we've got gobs of people applying, our best guess is we were guessing 30% might take that, and we do have cash flow for that. Other towns, when we've asked how are they estimating it, it's 20 to 25%, but nobody knows. So we've got to look.
I'm sorry, Marcia. Nobody knows, but we know that about 30 some odd percent, just over 30% of our people are escrow, and they're not eligible for this, meaning if you have a mortgage, your mortgage company is going to pay your tax bill. We're looking at a $35 million every 6 months that we collect. We are putting in place right now, when anyone applies for a deferment, they must prove that they've either lost their job or had a 20% loss in income if they're an individual, or 30% if they're a business. And we're putting together the criteria which the governor and the state has allowed us to establish what that criteria is. And we're going to be very careful on that. You're going to have to be able to prove it, that you have had this loss, so that we can approve it. WPCA is covered by this also, so we're coordinating with them, and they have agreed. I've talked to Nelson Malwitz about this, that simply if the town approves it and likes the documentation, they're going to use the same forms and application, so people don't have to do it twice with each organization. So I don't think that we're going to get a huge amount of that, but it's also, we're going to do, Marcia's working on it right now with Kevin, a worst case, best case, if everybody qualified in the town, if nobody qualified.
So that's more of a, that's a cash timing question.
Yes, it is.
Which is something we don't typically even think about. So I guess that's something that should be on our radar. From a budget standpoint, I know that at one of the meetings you built a collectability estimate of, if and impact. Are you suggesting, or should we consider reducing the collectability? I remember it not being that impactful, but I wanted to bring that up again since we're talking about it.
That's a good question. We'll look at that. This is really a Board of Selectmen issue, not a Board of Finance issue, but we want you guys involved as much as possible. The collectability issue, my guess is we might get a slight drop, but not much. But we're going to look at that and do some stress analysis on it.
Okay.
Yeah, and when we had talked about, we were talking about tenths of a percentage, and maybe we need to look at a bigger percent variances. And then we want to look at the other revenues again too, building permits, town clerk recording fees, what's the real estate going to look like, but all those I think we have to address in this as well.
Yeah, we'll look at that. Interestingly enough, I talked to our building department, and our building permit applications are up over last year this time. And I was a little surprised, but a lot of people are home. They're putting on decks. They're redoing their bathrooms themselves. They want things to do. So that won't be as affected as much as it possibly could be. But we're asking them to look at that, come back to us, and tell us what the trend is.
Okay. Marcia, anything else?
I'm done.
Perfect. Okay, just moving on to other things. Eileen is working closely with the Board of Ed. We'll be attending the meetings as much as possible, just for general housekeeping and just so that the town knows. Brianna has been researching other towns and what they're doing. She's written to a couple of the other Board of Finance people from other towns to see how they're handling, because we're looking at the problem. So Brianna, you want to take 5 minutes and go over anything?
Sure. I don't even know if it'll be 5, but so what I did is I started by looking at, I Googled all the towns in Connecticut, and then I went with all the towns in Fairfield County, and then I lessened it to the towns with the same government structure we had, and then I tried to pick the towns with closest population to try to reach out to similar towns that might be, you know, in our same situation. Those towns were Bethel, Monroe, New Fairfield, and Wilton had the closest in population to us, but Newtown and Ridgefield were like 24 and 27,000. So I chose them, but they're on the higher side. I emailed a couple, haven't heard anything back. I had read a newspaper article that Monroe was doing something where they were able to do what I read was an online referendum, but the first selectman said, no, that isn't happening. So he actually wanted to see the newspaper article where it came from. But Wilton did something interesting, which I thought, I read that they asked the boards to outline what services would be lost. So instead of just saying, you know, here's the cuts, here's this, here's that, what services will you lose at 0%, at a 2% decrease, a 5% decrease, and a 10% decrease? And that's what the Board of Finance asked the Board of Selectmen and the Board of Ed to come back with. Not really, these are your savings in this, just tell us what you're losing at these different percentages. They thought that that would be an easier way to look at it for the taxpayers. So I just thought that was interesting. However, they did say it was unclear how to finance ourselves if the revenue collections tank. So everybody that I've spoken to and everything that I've read, in my opinion, seems that everybody's in the same spot we're trying to do, is try to figure out how to get everything down to 0, how to lower everything. And at the same time, I don't see anything about future planning. So I think we're kind of really ahead of the game on that. I do have emails out, but I have not gotten anything back yet. So hopefully more to report in next meeting.
Okay, perfect. Marcia, you want to add to that you've been looking at things as well?
I did collect, I have been looking at things. It does seem like everyone's in the same position. Connecticut Council of Municipalities is having a seminar, webinar on Tuesday. They're going to talk about best practices in this type of a situation. So I'll be attending that. I'll be attending that as well.
Okay. Anybody else want to make a comment at this time on anything?
Or if anybody has anything they want me to ask any of the other towns, let me know.
One of the things, Brianna, if we could, when we look at these things, I sent you guys a couple of emails last week because Glenn had sent me some emails on towns doing this or towns doing that and everything. And it's a little harder. A 0% increase doesn't mean you really have a 0% increase. For example, the town of Lyme is shooting for a 0% increase in the mill rate, but they're having a 4.54% increase in their operating budget. And what they're doing is using general fund and other funds to offset their actual increase in taxes. So I would ask that you say, how are you getting there to this? What are you actually going to cut? What are you actually going to stop spending on?
That was what my emails were indicating. How are you getting to it?
Right.
No one seems to be answering it. They just seem to be saying, this is what we're shooting for.
Right.
And I tried not to focus on towns, to be honest, that were outside of Fairfield County, because all you keep hearing is Fairfield County's the hardest hit. Fairfield County's feeling it this, Fairfield County. So I didn't feel like if I went to Hartford or New Haven County, they may just not have information that would be prudent to us because they might miss the curve that we are already in.
You're right, and they're not getting hit like we are. So I think you're doing exactly the right thing. Thank you.
Right. I think, Steve, the exercise is geared towards that, our conversations,
Yeah.
because everybody's hearing zero tax increase, but they're not hearing there's no cuts to expenditures. They're getting there via different tools like we're talking about, surpluses,
General fund.
general funds. So,
Right.
but everybody's hearing other towns are doing zero increases. So that's why Brianna has taken this on to reach out and to say, hey, our town's actually cutting expenses, or are they not cutting expenses?
Right.
Or are they using, what tools are they using? Maybe it's a tool we haven't thought of, that they have a different tool that we can bring into the mix. So the exercise is geared to our conversations. Absolutely.
Yep. Yep.
And I haven't heard of one town. I've read every article I can find, maybe 20 articles, and I have not seen one that addresses what happens in year 2. I think there's going to be an awful lot of unpleasant surprises when they make big cut, they use big chunks of fund balance, and then they can't sustain it the next year.
Yeah. Or they don't fund their pension this year and they're going to play catch up, or OPEB. You know, I think we need to have a very balanced and equitable approach to this, because we do not want to put our residents in a position in the next 2 or 3 years of getting a 6% increase in their taxes because we did something this year to, you know, save them money. We need to be as careful as we can, but we have to be very careful we don't trip up the next few years.
Especially with the school coming.
Yes.
Right? I mean, that's the
Yes.
second bump that other towns aren't dealing with. So we're all in agreement, Steve. I mean,
Yep.
that's
I think we
why,
are.
again, we're not making decisions. And when we talk about, when Brianna talked about the different way towns are doing, asking for 10% fiber, we're just looking at everything. That's all. We're gathering as much information. We're not saying we're making cuts. We're not saying we're not making cuts. We're not saying we're doing this. We are a green field right now that are trying to put forth a plan, exactly what you just outlined. How do we keep the impact to the taxpayers this year as low as possible, not put ourselves behind the 8 ball year 2 or 3, and then really get our backs up against the wall with the new school?
Yes, I agree.
So that's why we have Dan's tree. That's why we're meeting every week. That's why we're pushing you and Broza and Marcia to get us numbers and scorecards, and we're going to make a group decision exactly to that theme, I think, or try to. How's that? And again, that's why we're gathering the data. Anybody else have a comment? All right, I'm going to wrap it up here for us before we go to public comment. How's that? Steve, a chore for you, please, is we're getting, no, and I don't know how to answer it, so we're working together, is we're getting a lot of emails about the charter versus the governor's rights of not being able to vote, who has the total say, the final say, and can we get a clarification? You've read some of the emails, I think, as well.
Yes, we can. We looked at this very, very carefully because I think everyone on this meeting and everyone in town absolutely believes in the voters' right, the residents' right to vote on a referendum. We've had Tom Beecher as our town attorney. He's looked at this very, very carefully. He's worked with the other attorneys. He belongs to a number of groups. Every single one of them says that the executive order from the governor is inviolable. We don't have a choice here. The Board of Selectmen was mandated to tell the Board of Finance to adopt the budget and set a mill rate. We don't have a choice. No one has even, and Tom's checked this, no one has even tried to challenge this in court yet, because it seems like this is absolutely possible on the part of the governor. So we are in a position, a very unenviable position, that the Board of Selectmen had a mandate that you, the Board of Finance, choose a budget for the residents without their vote. No one likes that. No one wants that. They don't. I don't think Sue does. I don't think Harry does, but we have no choice here. So all you can do is do the best job you can. And, you know, there are towns who have what they call an RTM, representative town meeting, to set budgets, meaning different parts of town vote on who their representative is going to be. And there's depending on the size of the town, between 15 and 30 people who get together. They act as almost like a town council, and they decide what the budget is. And people don't get the vote. In towns like Danbury, people don't get the vote on the budget. We cherish that ability. The town council, the council in Danbury sets the budget, and that's it. So we very, very much miss the right to vote on this budget. So you guys are acting as the RTM. You're the representative town meeting. You are the people who are gonna, on behalf of all the residents in town, because you were elected to represent them, set the budget. I think you're doing a really good job. I think you're asking all the right questions. I think you're not taking this lightly in any way. I think you're being so careful that you look at all of the issues and the problems, and there are hundreds of them here. We talked about them over the last 2 meetings. To get a budget that works for the town and works for our residents, doesn't hamstring us for the future, but still meets the needs of our residents right now. People are scared. People are upset. People have lost their jobs. People have lost income. And we have to be cognizant of that. And I think you guys are doing a great job doing that. And I thank you for all the time you're putting in. I'm sorry, I'll get off my pedestal.
No, it's all good. We appreciate it. I've also, along your lines of what you're speaking, is we've reached out to the chairman of the RTC. Brianna got a letter from them, and then having them talk on their committees. I reached out to Laura Orban as well to get her thoughts on it, and appreciate all the letters that they've sent in and their thoughts and the support that we are getting from them as well. We've opened the door up to both of those committees. Again, they're open to all the residents, obviously, but we've reached out to them and opened the door for suggestions, and if anybody has an idea or thought process. And we're probably bouncing them off of you as well in the process of this. I don't know what else to say other than that's where we're at right now. Again, we've put Dan's tree out there for decisions, and we're accepting letters. So anybody want to close out? I'm going to go around. Mark, are you on still?
Yeah, I'm here. So Steve, you brought up a good point about people losing their jobs. They're 6 weeks behind in reporting and paying people for unemployment. And the last numbers they have up are from April 3rd. And in the 18 days previous to April 3rd, 220,000 people in Connecticut lost their job. In a normal year, all of 2019, they lost 180,000 people lost their job. So in 18 days, when this pandemic was at the very beginning, before we even got in the heart of this, we lost 40,000 more jobs in the state than in an entire year. So, we don't take that lightly. We are doing everything we can to alleviate any of the stress we possibly can from the people. So
yep.
That's all
I agree with you, Mark. And a lot of the reporting, I have to tell you guys, today, our reporting at 4 o'clock this afternoon, we went from 100 to 125 people who had in Brookfield who have the coronavirus. That seems like a huge jump. That's a 25% jump. The problem is the state systems, unemployment, DPH, DECD, all of the systems are overwhelmed with the reporting. So we have to be very careful that we look at this, but you're right. Many, many people are either losing income, lost their jobs, lost the number of hours that they're working. And we have to be careful, which I think you guys are all doing.
Marcia, before Mark goes on, hold on, Mark. I'm going to roll into you, so relax. Marcia, put up that presentation I sent to you, please. It's going to roll into what you're saying, Mark, so then you can continue on. We're close to ending, so do you have that screen, Marcia? Can you put that up? All right, so go to the next slide there, Marcia, right there. Yeah, perfect. All right, so this is the current unemployment by town, Mark, as of March 2020. So you can see Brookfield is, whoa, what'd you do,
Whoa.
man?
Yeah, it's not, I'm gonna escape out of that.
Yeah, just go with this. We could see it. So you can see right now we're at 3.2%, Mark, right?
Yep.
And you can, but this is again, March 2020 current date. I just want to show
Hold
when we're
on.
looking at this,
Hold
right?
on, Glenn.
Yep.
The data from March.
Wait, let me finish the presentation. You'll get more information. How's that?
Okay.
So if you see here on the side, you can see the amount being paid is not a lot of money to the people that are out of work, correct? So now let's go to the next slide, Marcia. What you're trying to say, Mark, is if you look at the 2020 March numbers, it's 23,000 filed, right? That hasn't caught up with that front page. The highest number on the,
and it's actually more than that. I have that website up on my computer, and it tells you the main note, the first note on the page, the March payroll and unemployment statistics do not reflect the reality of recent COVID-19 related impacts on Connecticut's labor markets. Both surveys, business payroll and household unemployment, use data from the week that contains the 12th of the month. While we saw some impact on jobs that week, we did not see the significant rise in layoffs and unemployment insurance claims until the following week. So that their own website is telling you that that information is way wrong.
absolutely. Again, let me finish. You see the 23 is bigger than any number. Marcia, go to the next slide. Here's your number that you're talking about. 220,000 initial claims, 13% of the state. Right?
Yep.
So now Marcia and I were talking about this today. Basically, what it is, using the percentages from that first chart, basically Brookfield will be at a 10% unemployment rate based on formulas and numbers projected. Obviously, it's not a sound number.
It looked to be about closer to 12 to me when I did the math, but okay.
So this is just talking, I think, to your point, right? That we're going to have a big curve ahead of us. Yes or no?
Yes.
So go ahead. You can finish now.
Yep, I was done.
Wasn't trying to make you done. I was just trying to show it where people could see it, that this is, you're talking about concerns of the people who are losing their jobs. It's going to be a fairly significant number.
And keep in mind, that number is going back from April 12th. We are April 2nd. We are 20 days beyond that.
Correct.
And they haven't even updated because they're that far behind.
Right. So I think that's where, I wanted to show that in a point where people could see it and feel it. How's that?
Thank you.
Anybody else? So then Steve, Marcia, Ken, and Rosa, you're going to try to get us a better scorecard for next week?
Yes. Thank you.
I think that's it. Let's go to any public comment. No public comment.
I will make a motion to adjourn.
Second.
All in favor?
I'm sorry. I want to comment before that because we can't comment after. Steve, are you going to take ownership to fix it so that our meetings can start on time and we have a dedicated meeting time from here on out?
Yes, we are. We were talking about this today. I think this is going to go on longer. We have 3 licenses for Zoom, which have proved pretty well. They're working pretty well. The problem is all the licenses are in the same name for something crazy reason, and Zoom won't let you use all 3 if you have the same host. So we're fixing that. And what we're going to do is the Board of Selectmen will have their own Zoom account. The Board of Finance will have their own Zoom account, and a couple of the other boards will have it. And no one else will be able to use it, so we won't have a problem. It's $15 a month.
And maybe if we reserve from 6:30 on instead of 7 o'clock and
yeah.
And great,
well, once we get you your own Zoom account, it doesn't matter. You can call a meeting in 3 minutes.
Thank you.
because we can't have this. The meeting's got to start on time.
Steve, I just wanted to point out, I know that, it's $15 a month. It's not like that crazy, but from what Eric told me earlier this evening, if someone just appoints a co-host, you don't have to actually have a separate account because that co-host can
Yeah,
open it up.
we tried that tonight, but they wouldn't let us do it, Rosa, but thank you.
Oh, okay.
So we'll fix that, Mark. It'll be fixed tomorrow.
Thank you, Steve. That was it. I continue my motion to adjourn then. Sorry.
Second. All's in favor?
Aye.
Aye. Thank you.
Thank you.
Good night, everybody.
Night.
So long. See you next week.